Okay, so this last section is here. So those distributions that we just talked about, the partner is still an owner in the partnership. It did not change their ownership percentage, right? Because all they're doing is taking money, they're withdrawing money from their account, right? That partnership, they're withdrawing the money. In these examples, the partner's interest changes, either through the partner selling their share of the partnership interest. So if I have a 50% interest in a partnership and I sell it to somebody else, now I'm going to have, and I sell all of it to somebody else, now I'm going to have a 0% interest in that partnership. I am no longer a partner. That other person is now a partner. Or it could be that the partnership just dissolves. Or it buys out a partner. So you're not selling it to another individual, you're selling your partnership interest back to the partnership, and then the partnership interest is going to be spread amongst the remaining partners. So, most common way to dispose of a partnership interest is either through partnership liquidation or by selling the interest. A liquidation occurs when a partner's entire interest is redeemed by the partnership. So if the partnership buys out my interest, so let's just say we've got a partnership with 3 equal partners and one of the partners decides they want out, the partnership buys them out of their share, and now the partnership is owned 50-50 by the 2 remaining partners, right? So that's a liquidation. Most of the rules concerning non-liquidating distributions that we just talked about also apply to liquidating distributions. So a distribution of money in excess of basis will cause a capital gain. So again, I own 33.3% and the partnership's going to buy me out. If my basis in that partnership was $50,000 and the partnership's going to pay me $100,000, that's $50,000 more than what my basis is. I've got a $50,000 capital gain. The other $50,000 is just my return of capital. What I had originally, I've already paid tax on that. I either contributed it originally or had to claim income on my tax return at some point in the past when I owned that. So if property is received in a liquidating distribution, no gain is recognized. The basis of the property is adjusted. So one difference between liquidation rules and regular distribution rules is that a loss can be recognized on liquidating distributions. So if my basis in this partnership was $50,000 and they're giving me $25,000, the partnership's paying me $25,000, means I have a loss of $25,000. Because I'm liquidating my portion, I get to recognize that loss, just like any other type of capital loss. If I bought a stock for $50,000 and I sell it for $25,000, I get a $25,000 loss. So a loss occurs when the amounts received in liquidation are less than the partner's basis, the partner's outside basis. Again, outside basis is the basis that each partner calculates, okay, for themselves. A major caveat is that the loss can be recognized only after the final payment is received from the partnership and when only money, receivables, and or inventory are distributed. So if they're distributing property, it's a little bit different. But so here's an example. Cassandra has a $20,000 basis in her partnership. When she receives a liquidating distribution from the partnership, she's going to get $12,000 of cash, so a $12,000 check, equipment with a basis to the partnership of $6,000, so now we're up to $18,000. In this case, Cassandra is recognizing no gain or loss on the distribution. The basis of the equipment is going to transfer over. That $8,000 to her, or to the partnership, is going to now be her basis. $20,000 partnership minus the cash received of the $12,000, but now she's going to get to recognize a $2,000 loss because that's over and above, or actually under what her basis was in that partnership. Same facts, except Cassandra receives $12,000 of cash and inventory with a basis to the partnership of $6,000. Cassandra is going to recognize a loss of $2,000 on the liquidation, the total $18,000 minus the $20,000. The inventory is going to have a basis to her of $6,000. Again, so that basis is going to carry over. If several assets are distributed, the partner does not have enough outside basis to cover the basis in the partnership assets distributed, then the outside basis is allocated in this order. So first, the partnership basis is reduced by cash. So in this example up here, she had $20,000 basis. She got $12,000 of cash. That would be the first thing we subtract. So now we're down to $8,000 of basis. Next, any remaining basis covers the basis in receivables and inventory. So if there's also receivables and inventory, that would be next step. Any remaining basis is allocated to the other assets distributed in proportion to each asset's basis. So we've got an example of what we mean by that here. So we've got Kelsey has a basis in her partnership interest of $10,000. This is what she's getting from the partnership in exchange for liquidating her portion. They're going to give her $3,000 of cash, inventory worth $2,000, or not worth $2,000, has a basis of $2,000, equipment that has a basis of $2,000, land that has a basis of $4,000. So in total, what do we have here? 6, 7, 8, 11,000, but her partnership interest was 10,000. She has no recognized gain or loss. What she's going to do, though, is her $10,000 outside basis is going to be allocated as follows. So $3,000 toward the cash. So we would subtract the $3,000 from that $10,000 that she's getting, the total her partnership interest. Inventory, $2,000. So would subtract that as well. So now that has a basis to her of $2,000. The remaining, though, $5,000 of basis, because these totaled $11,000, but her basis was $10,000. So the remaining $5,000 after we subtract this, of that $10,000, we are going to apportion to the equipment and to the land. Now the equipment's basis to her is going to be $1,667. The land's basis is going to be $3,333. And we do that by taking the $5,000 that's remaining times the proportion of the remaining $6,000 of the remaining $6,000 of value of these bases. So there's $6,000 of basis remaining, but there's $5,000. There's $6,000 of basis in the assets remaining. There's $5,000 of basis in the partnership remaining. So we have to allocate that difference to these two assets. The equipment, so the remaining partnership basis is going to be multiplied by the proportion of the asset basis to the total asset basis. So the individual asset basis to the total asset basis. So that's how we're coming up with the remaining basis that she is going to have on her books for that. So if she turns around and sells the equipment for $2,000, she is going to have to recognize a gain at that point of $333. $333. Okay. Now, the other way to dispose of it is if we sell a partnership interest. Now, in the first example, it was liquidating it. The partnership is essentially absorbing the partner's interest by paying them out with something to get them out of the partnership. Other option is to sell it to somebody else. So I've got a partnership. It's worth, it's got a certain basis. I sell it to somebody else, and now they own it. The sale of a partnership interest is similar to the sale of any other type of capital asset. Partner is going to determine the amount realized from the sale, subtracting the basis of the partnership interest at the date of the sale. So we're going to use that basis to determine what our gain or loss is. So if my basis is $50,000 and I sell it to somebody else, a separate party, for $70,000, I've got to recognize a gain of $20,000. It's a capital item, assuming, and the holding period is going to be however long they held their partnership interest. So it's just like any other asset that you sell. So here's an example. We've got Jana purchased a 30% partnership interest for $23,000 in February 2022. Her share of partnership income in subsequent years. So this is just showing the flows throughout the years to get to what her ending basis is for determination of gain or loss on this disposition. So $12,000, beginning basis was $23,000, and then there was income of $12,000. She paid tax on this in these years. It was on her K1, she paid tax on it. $15,000 in 2023, $8,000 in 2024. So the calculation of the gain or loss, she's getting $74,000 for her interest. She's going to recognize, going to subtract the basis. She's going to recognize a long-term capital gain because she purchased it originally back in 2022. It's a long-term capital gain of $16,000. So partner may be subject to ordinary income from the sale if there is substantially appreciated inventory or accounts receivable in that partnership. The reason for that is if they remained a partner and they sold the accounts receivable or sold the inventory, that would be ordinary gain. Okay? So if the partnership sold or collected these items, ordinary income would result. The partner would share in that ordinary income. A partner who is allowed a capital gain treatment on the sale would essentially be converting ordinary income to capital gain income if they didn't have to do that. They would get a benefit of that lowered capital gain rate. So same example here, partnership has uncollected accounts receivable with a fair market value of $20,000 and a basis of 0. Jana's share of the receivables is $6,000. She had a 30% interest. So if she stayed as a partner in that partnership, eventually there would be in the ordinary income box on her K1, over time, $6,000 would show up because that's how much that inventory was worth. So $6,000 of that $16,000 gain is now reclassified as ordinary income. The remaining $10,000 is capital gain. So she's going to pay different tax rates on those different types of income. Let's see. All right, so that is a liquidation versus a sale of a partnership interest.